After a decade running accounting for startups, the number one money mistake I see founders make is treating accounting like an annoying checklist rather than a decision tool. They wait until the tax time or a board meeting to then get to know their financials versus having it be at their fingertips, the tips of the tongues. The stronger the founder, the more comfortable they are speaking to their financials. Everyone says clean books. Here's what they actually mean and signs that yours aren't. Clean books mean that you can answer any financial question about your company in about 5 minutes. That's it. It's not anything fancy. It's being familiar with your financials and knowing them. That's what clean is. It's not having any follow-up questions. It's not having any hesitation to answer those questions. The exact moment a founder needs to stop doing their own books, I don't think they ever should be. A founder should be focusing on what they are building for the company and leave the books to someone who knows how to prep the books. There's a big difference between an accountant who reports your numbers and one who explains them. Someone who reports your numbers can tell you that your gross margin last month was 38%. A lot of people can tell you that by doing some simple math. One who explains them is going to tell you why it was 38%. Was it because you had a customer churn? Was it because you had hosting costs go up exponentially? That's the difference, and that difference matters. Here's the one number every founder should be able to answer in their sleep. It's their runway. How many months do you have left of cash at your current burn? Without knowing that, you could run out before you expect it. You might expect to have 6 months, but maybe you just made a big prepaid that is being amortized on your books on a monthly basis, but it was $200K out the door, but maybe only $10K expense a month. That is very important to know. Runway versus financials can be different. Here's what most founders get wrong about the difference between cash and profit. Cash is a fact. You can show profit on your financials, but if your AR is continuously growing and your cash is continuously falling, you might still miss payroll, but you might have 4 customers. So it's important to combine cash with that profitable outlook to make sure that you're collecting the cash so you can continue operating. Trust is built or broken on that first close. If it's clean, if it's understandable, if the data is digestible, and also communication. A lot of times you don't know what you don't know until you get into that first 30 days. If I say I'm going to have you up and running in 2 weeks, but I run into a massive hurdle, maybe you haven't had a compliance checklist done for 2 years. That means I'm going to take a little bit longer. But communicating that versus just going into a hole, that builds trust versus break it. So you want the financials easily digestible, but also communicate where you are in the process. Here's where AI generally helps in accounting and exactly where people get burned trusting it. AI is great with the repetitive pattern work, entering transactions, reconciling statements, downloading reports, formatting those reports in a digestible way. Where people are frequently getting burned is trusting it to do the analytical piece behind the numbers, reviewing why your gross margin dipped. AI can tell you how much it dipped by, but it can't do a full analysis of why. Did you lose a customer? Did costs go up? Was there a massive prepaid that's sitting on the P&L, so the balance sheet? You need that analytical viewpoint outside of AI. Surviving a brain aneurysm, and I build finance automation. And they came from the exact same instinct. I was not okay sitting in the unknown, sitting in the questions, sitting in the pain, sitting in the area where I knew there was room for improvement. So with my brain aneurysm, with my memoir, I started asking questions. I started writing down what worked for me. And same with the finance automation. You have all these tools at your fingertips, and I'm not going to just sit and know that there's a better way to do these processes now because I'm too scared to get to those tools. So I wrote the memoir because I wanted to explore my strengths there, and I built the finance automation for the same reason. After everything, here's the kind of founder I most love helping now. I love working with founders who are excited about what they're building because I'm excited about what I'm building. I love to learn from founders in areas that I'm not an expert, and I love to teach founders in the area that I am experts. It's always the best working relationship when we both enjoy learning and teaching each other and get excited about how we're working together. Going through all that made me realize what is urgent versus problems that can be solved in pieces and in a calm fashion. When founders come to me with a fire drill, I like to address it in pieces so that I can show them that as scary as it may seem to them, we can handle it. If they have a board meeting in a week and they need financials that they haven't had updated in 3 months, we can figure it out. The financials might not be the most buttoned up version, but we are able to get to the solution with chopping up the problem and addressing it piece by piece. And I think that's what it taught me. It taught me that we don't need to tackle the big overarching save the world problem in one setting. We need to chop up that save the world problem and tackle it piece by piece so that we can do it correctly, well, efficiently, and calmly.